Everyone has their own personal milestones on their Bitcoin journey. The first time you heard about Bitcoin, whether you acted on it or not, when you finally got off zero, your first million Satoshis, your first whole coin, etc. And here on the Bitcoin Bulletin Podcast, we have achieved many milestones ourselves, including a very big one that we are going to celebrate together today. This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy. Guten Tag, buenos dias, morgen, and welcome to episode 278 of the Bitcoin Bulletin Podcast. Once again, I am your host, Chris, and I am coming to you from the Bitcoin Bulletin Studios on Florida's gorgeous Space Coast. Plebs, I am in shock. I've been planning on building up to this for quite some time, and I've even been talking about it for the last several episodes. But now that we are here, starting today doing the show prep, was almost surreal. A little bit later today, when we make our weekly DCA purchase, it's going to round out 5 full years of stacking Bitcoin together. Don't worry, we will keep stacking, but the fact that we have been doing this for so long, it just feels strange. I don't know the right word for it. It just doesn't feel like it has been that long. And I guess a lot of things feel that way in life. If you're a parent, you especially know what I'm talking about. Technically, 3 days from now, July 25th, is the Bitcoin Bulletin Podcast's 5th birthday. But we began our stacking journey exactly 5 years ago next Wednesday, which means that today is the final Wednesday in our 5th year of stacking. When we meet together next week, we will be beginning our 6th year. And so that's really cool, and we're going to get into that obviously a little bit later. A side note, Bitcoin related, but kind of a tangent. I have been running my own Bitcoin node since well before I began this podcast, but recently I started thinking about building a second one. And there are a lot of reasons I wanted to play with some of the other options that are out there, but mainly I wanted to see just how hard has it become for ordinary plebs to spin up a node. I've experienced running both Raspberry Blitz, Raspberry Bolt, I believe before that, and Umbrel nodes. And I actually really like the Umbrel solution. A lot of people poo-poo it because it's the node in a box kind of solution, but I think the UI, the UX is absolutely amazing. And it lets you run everything you want. If you run a node, you probably need to run an Electrum server so you can connect your wallet to it so you can verify your own transactions, and maybe you want to run your own mempool.space instance, et cetera. And Umbrel lets you do all of that. And it's really, really easy to do it. It's almost like using Windows. I mean, it's really straightforward in a way that even your boomer aunt, for example, could probably figure out. I mean, at least once it's all set up and running anyway, maybe not putting the Raspberry Pi together, but I'm getting that's kind of another tangent. So I purchased a brand new Raspberry Pi, and I got the newest, most powerful one I could. I got the Raspberry Pi 5 and the 16 gigabyte version. That was the largest one I could find. And again, I've run, nodes on Raspberry Pis before. I ran my first Raspberry Pi node back in 2019. I later upgraded that one to an 8 gigabyte Raspberry Pi 4 because it was just not cutting it. And of course I had to upgrade hard drives because the blockchain itself is getting really close to a terabyte. And if you run any other apps like your BTC Pay server or whatever you want to run on your Umbrel, you need a little bit of extra space anyway. So upgraded to a 2 terabyte hard drive and made a few other changes. But basing my experience on then, maybe not the first node I ran, but the last one I can remember putting together 5 or 6 years ago, it took about 4 or 5 days to do the initial block download, get that all synced and up and running before you could start using the node. And that was granted with really, really cheap software. The Raspberry Pis aren't super powerful to begin with. They're getting better and better, but they're no supercomputer. They're no gaming PC, for example. But, and I also have really lousy internet here. 5, 6 years ago, it was absolutely horrific. I mean, I'm sitting here on a barrier island that kind of sticks out into the Atlantic Ocean like a barnacle on Florida's east coast. I mean, you can see it on the satellite, or if you look at the map, Florida has that little triangle notch that sticks out on the east coast, and you got to cross over two big bodies of water just to get here. If you're in Coco, which is the mainland, down the I-95 corridor, first you have to cross over the Indian River Lagoon, and then you get into Merritt Island, which is a fairly large island of its own. Then you cross another 3 miles of lagoon, the Banana River Lagoon, and then you're in the Cocoa Beach, Cape Canaveral barrier island that runs down the east coast here. So a lot of things are horrible on an island. That's the way it is. But the internet's gotten better. But keep in mind, your results, if you're spinning up a node, might not mirror mine. If you're living in a big city with super fast, reliable internet, your power doesn't drop off a couple times a day every day. You'll have a little bit better experience. But getting back to the node, the new Raspberry Pi is obviously a lot more powerful than what I was dealing with 5 or 6 years ago. I did have one snag setting up this node that I do want to go over, because most people might not ever experience it, but if you do, I didn't want you to get disheartened and give up, because it can happen to plug that node, slap it all together, and just nothing happens. Apparently, at least at the time of this recording, Raspberry Pis have a compatibility issue with some of the latest, the most top of the art, top end solid state drives. I purchased a Samsung T9 because it's supposed to be one of the most reliable SSDs out there. It was highly recommended as far as like read write and failure, etc. It's also really expensive. I mean, I paid more for that drive than I did my entire first node setup, for example. But the T9 and probably other state-of-the-art drives that are competitors apparently use a new controller that has some compatibility quirks and some Linux and embedded device issues. So it wouldn't boot. And again, the T9 is a pretty high-end drive, and it's you're going to spend $400 or so on a 2 terabyte T9. But again, it wouldn't boot, and that wasn't an Umbrel problem. I tried booting the Umbrel, then I just put a micro SD card in with Raspbian. I put the new Raspberry Pi OS, and then I put the older Raspbian in it, and it would boot and it would freeze. And the problem is it was trying to rewrite a partition that already existed over and over again. It would just do that forever and never get past that. So after a decent amount of research and troubleshooting, because I couldn't find any bug reports or anything related to this, I finally just swapped out to a Samsung T7, and boom, we're off to the races. No problemos. So in case this is still an issue and you try to spin up a node, especially if you try and spin up a node with a T9 and a Raspberry Pi 5, just be aware. I mean, you don't really need that high end of an SSD anyway. It was a little bit of overkill, but I don't know why. Even a Samsung T7 is probably more than you need. But I digress. We do have an awful lot that I want to talk about today. We've got, of course, our Bitcoin news segment, and then we have our weekly DCA segment. But before we dive into all of that, we'll start off by taking our customary look at Bitcoin's vital statistics. At the time of this recording, we are sitting at a block height of block 959,182, and Bitcoin is ringing in just under 66,000. It was 66,000 most of the day, I think, glancing at my Brains deck, which it's kind of like a block clock, but it's from Brains. Anyway, currently the current price of Bitcoin is $65,980. And despite the fact that's down from today, I know a lot of people are watching thinking, when are we going to hit 66? I saw a few posts about when we hit 69, the 69,420 meme, but nonetheless, we're still more than $1,000 higher than last DCA Wednesday, and almost $4,000 higher than the week before that, and almost $6,000 higher than the week before that. So that is really encouraging, especially for a lot of people that were worried that the bear market was far from over, that Bitcoin is going to zero or whatever crazy FUD you were listening to. Bitcoin's current price, though, means we're going to get fewer Satoshis than we did in the previous weeks. Today, we're going to get 1,516 Satoshis for every single US dollar that we convert into Bitcoin. And that's still great compared to what we were getting when Bitcoin was near the all-time high. Remember, at 100,000 US dollars, you get exactly 1,000 sats per dollar. And then at $1 million US dollars, you're only going to get 100 sats per dollar. So the higher the price of Bitcoin goes in fiat terms, the fewer Satoshis each fiat cuckbuck will purchase you. That's just the way the cookie crumbles. Bitcoin's current price, and I'm going to have to pull up a different set of notes here because I was so distracted by something else. Bitcoin's current price gives it a market cap of 1.32 trillion US dollars, so edging back up 0.2 trillion higher than 0.02 trillion higher than last DCA Wednesday, climbing up from what's the lowest we saw? I mean, we ducked down to at least 1.2 trillion or really close to 1.2 trillion. But I don't think we've gotten a lot further below that. I know I've expanded upon a couple of times now that depending on how low this bear market goes, if we've bottomed out or at least got near the bottom, that's actually a pretty significant metric. That if this turns out to be the first time in Bitcoin's history, the first bear market in Bitcoin's history, that we haven't gone back below a $1 trillion market cap, that's really, really exciting. For those of you who value your wealth in gold, one Bitcoin will currently purchase you for those who value wealth in gold, it will currently cost you 15.7 ounces of gold to purchase just one Bitcoin, up another 0.3 of an ounce over last DCA Wednesday. And again, that's with gold having gone on that epic tear. That was a once in a lifetime tear for you gold bugs out there listening, because Bitcoin had a heck of a run, and then it didn't do a whole lot of anything for decades, and it sat around $300 an ounce for most of the 90s. Recently, it had worked its way up to like $1,800 an ounce, but then out of nowhere, Bitcoin, gold exploded to more than $4,000 an ounce. It's since pulled back a little bit from that point. But so even with gold having its heyday, the amount of Bitcoin that each ounce of gold will purchase you continues to diminish as even gold trends to zero in Bitcoin terms. And I apologize, I didn't prepare this stat either. I don't know what I was thinking. I told you it felt weird and surreal doing my show notes today, thinking about the significance of 5 years of this podcast and how it just didn't feel that way. And so I didn't put our pizza statistic together. But fair to say, you're going to get a few pizzas less than last week, where one Bitcoin would purchase you 3,626 large pepperoni pizzas, which is pretty amazing considering that the first ever real world transaction with Bitcoin was when Florida programmer Laszlo Hanya, that first transaction, he paid 10,000 Bitcoin for 2 Papa John's pizzas. So I thought it was fun because Bitcoiners like to celebrate Pizza Day to follow that statistic. So we've gone over that stat every DC Wednesday for the last 5 years, except for today. And we went over it today. I just didn't have the exact figures for you, and I apologize about that. That one stat that has been my favorite statistic for the entire history of this podcast, and one stat that I definitely have ready to go over, is Bitcoin's 24-hour average transaction rate. And currently, Bitcoin is humming along at 5.93 transactions per second. That is down a little bit from last week, 6.35 transactions per second, but absolutely screaming considering when we first started this podcast 5 years ago now, we were really happy to see more than 3.14, 3.15 transactions per second. So that's really cool as well. The Bitcoin mempools are about the same as they were last DCA Wednesday. Clark Moody's dashboard has 2,024 transactions pending their mempool, roughly the same as he had last DCA Wednesday. Mempool.space has 86,330 transactions pending their mempool. That is actually 13,000 transactions fewer. Of course, they run a much more liberal mempool. They allow transactions that include less than a 1 sat per VByte mining fee, for example, into their mempool, and those are predominantly spam transactions. So hence the difference between the 3,000-ish transactions and almost 100,000 transactions between the two mempools. But it's fun to go over both stats because it really gives you a bigger picture as to what exactly is going on out there on chain. But speaking of on chain, if you do need to make an on-chain Bitcoin transaction, it's a little bit cheaper this week than it was last week. Clark Moody's dashboard is saying a fee of 2 sats per VByte will be mined in the next block. And mempool.space is saying that it will also only take a fee of 2 sats per VByte to be mined in the next block. And putting that into terms of US dollars, now when you send a Bitcoin transaction on chain, what you have to pay to have that transaction mined is determined by how much data that transaction you're sending is. And a lot of things influence that. If you're combining multiple UTXOs, et cetera, and what type of script you're using, whether you're using a legacy script, et cetera. But the bottom line is every transaction, it's like a file in and of itself. Some movie files or some music files are larger than others. So you take the size of that file and then you multiply it by the 2 sats per VByte. And then you figure what the US dollar value of those Satoshis would be. And currently, plebs, that's just 16 cents in US dollars to wield the most powerful financial technology ever discovered. And that's pretty incredible. We have not had a mining difficulty adjustment since the last time we met. The Bitcoin network adjusts how hard it is to find a block every 2016 blocks, which works out to theoretically about every 2 weeks. It depends on how fast or slow those blocks are coming in, because it's not human time, it's block time. But 2016 blocks, if you average once every 10 minutes, works out to be every 2 weeks. And that's the goal, one block coming in once every 10 minutes. We are currently 434 blocks away from the next Bitcoin mining difficulty adjustment. So a couple of days worth of blocks to go still. And depending on where you get your data, it's looking like we're going to see another potentially decrease of as much as 1.92%. And the reason for that is that blocks have currently been averaging 10 minutes and 5 seconds, which is pretty close, but it's obviously a little slower than once every 10 minutes. And so the protocol takes that average and says, well, we need to reduce the difficulty by 1% or 2% to speed those blocks up and get them coming in at once every 10 minutes. Now, the Bitcoin mining difficulty, just like the price, if you zoom out, it has been trending up and to the right as more and more, mining hash power is added to the network. Those miners get more and more powerful, even if even if some miners are coming off, they're being replaced with more powerful miners. But just like the price, sometimes you see the down days. Same thing with the hash rate. Sometimes you see that network hash rate come down, whether it's on purpose, voluntarily, like the miners that have the demand response agreements in Texas, et cetera, where if there's a huge demand for electricity, they agree to shut down until that demand is eased a little bit, so that electricity can be used by houses and hospitals and things like that. And so there's a number of reasons why sometimes we see mining difficulty dip. Apparently, that's going to be the same case in just a couple of days, sometime around July 25th. But, don't fret. We still have an astounding 892.9 exahash securing the network, according to the average of the last 2016 blocks. If you look at the 90-day estimate, that's 940.9 exahash securing the network. Now, the reason that those numbers are so wildly varied is because there's no official statistic of exactly how much computing power is on the network. We don't know. Nobody has a count of every miner or every miner that's out there on every rack in every miner farm, or even if you're running one of those little, low power solo miners in your home. Nobody knows exactly how much mining power is out there. The best we can do is we look at the average time that the blocks are coming in, and we know what the mining difficulty is. So from that, you can extrapolate what hash power must be securing the network. And that's just a guess. So that's why we use those 2 different metrics. But it is important to remember that when we first started this podcast 5 years ago, there were only about 85 to 90 exahash securing the network. So that is more than a 10x increase of computer power we've seen over the 5 years that we've been doing the Bitcoin Bulletin Podcast. So even though there's ebbs and flows sometimes in the forecast amount of hash rate, and sometimes that's just because, finding blocks is random chance. So it could look like blocks are coming in too slow, and that could be just the way it is, which is why Satoshi decided he wanted to wait 2016 blocks to make that guess, whereas if, there were some older altcoins that made that mining difficulty adjustment on the fly. And that was a disaster. I've spoken about this before when I relate it to an airplane's autopilot. If an airplane's autopilot is overly sensitive and you're trying to fly an invisible line in the sky and you're off a little bit to the left, or the plane will come back right, and then it'll overshoot that invisible line in the sky, and then it'll come back left, and it'll just make these little tiny S turns across that invisible line, never flying a straight line. And it actually means you're going to take longer to get there, because it's like when you're walking your dog, you might go for a 5-mile walk, but your poor dog goes for like a 10 or 15-mile walk, because they run ahead of you, and then they run behind you, and then they run ahead of you, and then they run back behind you. And so it is with older airplane autopilots, and with altcoins that have different mining difficulty determinations, or used to. But the point being, Satoshi took a relatively large data set and gets a pretty good example of where mining difficulty needs to be. That's obviously, I think, one of the most genius aspects of the Bitcoin protocol, but I'm getting off onto another one of my infamous tangents. Real quick, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 is a Bitcoin native way to listen to your favorite podcasts, and as such, it allows you to contribute value back to this podcast or whatever podcast you enjoy listening to by either streaming sats while you listen or by sending a boost. A boost, of course, is a shout out. It's a message. You could say, hello, let me know what you think about the podcast. Put out a notification about an upcoming Bitcoin meetup, or say whatever you want. Just, sometimes people say just funny things on boosts to podcasts. But the point being, because that shout out is a Lightning transaction, you're sending value back to the podcast, contributing some of the value that you feel you've received back to the podcast, allowing us and other podcasts to not have to take on sponsors or do other things that would involve selling our soul and maybe influencing our opinions. Most importantly, though, when you do send a boost, we read it on the next episode. All right, on to the news. We've talked an awful lot about bear market bottoms and cycle history recently, and I don't want to rehash all of that too much, but one thing that I've said over and over again that has traditionally marked the end of a bear market, or at least triggered that final capitulation phase that will eventually be the bottom of that bear market, is when something big breaks. And I don't mean a bug in Bitcoin. I mean something in the system, something Bitcoin related. Previous bear markets, for example, marked the end of the ICO scam. All the initial coin offerings came crashing down. And remember the everything is blockchain scam? I mean, even like what was Long Island Iced Tea? They just changed their name to Long Island Blockchain, just including the names blockchain in their name. They didn't do anything else Bitcoin related, and their stock went through the roof. And that was just stereotypical of the blockchain craze that came to a screeching halt with the ensuing bear market. But of course, last cycle, we had that Terra Luna debacle and the breakdown of that Bitcoin yield schemes, and along with that, the tanking, the bankruptcy of BlockFi, and ultimately that it all came to a head with what was, I think, the biggest Bitcoin scam of all time, the collapse of FTX, when it turns out that Sam Bankman-Fried was using customer Bitcoin to buy real estate and give gifts and bribe politicians, etc. So the point being, we were in a bear market, and then you just started seeing these cascading collapses, these failures. And it is with every cycle. You have these scammy things that are going on in the periphery of Bitcoin, and the bear markets break them. And when they do break them, there's that one last capitulation down. The price tanks like it did after the collapse of FTX, and then the bottom is in. Well, this week appears to be the end of the road for what was, I believe anyway, a really big drain away from Bitcoin, with the paper Bitcoin summer and all of the so-called Bitcoin treasury companies, etc., that were trying to ride on the coattails of Michael Saylor's MicroStrategy. Literally billions of dollars were sapped away that could have potentially flooded into owning actual Bitcoin, that flowed into the so-called paper Bitcoin products instead. And a lot of people, including myself, attribute that to why maybe the price of Bitcoin didn't go higher this time. A lot of people have been lamenting that Bitcoin, this bull run, we didn't get a euphoria phase. We didn't get a blow off top. And I've said previously, several times at least, that I think we did have a euphoria phase, but the euphoria wasn't so much in Bitcoin. It was in the ETFs. It was in treasury company stock. It was in products like Stretch and Misty that people were pumping money into. Even Bitcoin influencers who promote themselves as Bitcoin maxis. I called one particular influence out, not by name, but if you've been following him, it was very clear who I was talking about. But the point being, literally billions of dollars that could have gone into pumping the price, supply and demand. When there's more demand and a fixed supply, then the price goes up. And so I think that's one of the reasons why it feels like we didn't have a blow off top this cycle. But along those lines, yesterday, Jack Mallers made a big announcement. going on Twitter, for example, or X, and posting that he was stepping down as the CEO of 21. 21 being the big treasury company that was basically a Wall Street backed treasury company that they kind of were making him the figurehead of, and it was kind of a weird mix anyway. I'm not sure. I just felt uncomfortable with Jack Mallers being there, and I didn't know whether that was diminishing to Jack's character that he would do that, or I don't know. I didn't want to judge him. I like Jack Mallers a lot. I love Strike. When we do our Bitcoin purchase, we're going to do it on Strike. In fact, it's already happened because it should have happened a few minutes after I started recording. Point being, apparently Jack has done the right thing and stepped down as the CEO of 21. I'm not the only one that feels this way. The comments were overwhelmingly positive on his post, with OGs like Newt Svanholm replying simply, "Welcome back." Sean Harris replied, "Happy for you, bro." Stefan Livera, who's been a little controversial, but definitely an OG, replied, "Good on you, Jack." Even Dom Bay, who's the California firefighter union president, who's been instrumental in bringing Bitcoin to union treasuries, he replied, "Onward, great work on the horizon." So glad to see Jack hauling in, but getting back to concentrating on Strike, because that's a Bitcoin product that I use that I think has tremendous potential for the future. There's a lot of things that are going to change about Bitcoin over the next 5, 10, 20, 100 years. When Bitcoin is the global reserve currency, when everything is based on Bitcoin, there's going to have to be a lot more TradFi-like things that function with Bitcoin. And Jack's one of the companies that's kind of building towards that. It's got to start somewhere, and it's good to see him focusing back on Bitcoin and Bitcoin Maxi related products. But most importantly, what that announcement signals to me is that the euphoria paper Bitcoin summer is over. I mean, that bubble has popped, and it wasn't just 21. Literally on the same day, BitcoinTreasuries.net posted, "Just in, shareholders of Mark Moss-backed British Bitcoin treasury company Satsuma Technologies have voted to sell all of its remaining 668 Bitcoin, return capital to shareholders, and shut down the company." Of course, this trend really started accelerating back in March with Sequans, when they started selling off their Bitcoin at a significant loss. But remember, there was also Bitdeer, which completely liquidated its Bitcoin treasury, and even Bitcoin mining company Mara, which, they not only began pivoting some of their electricity usage towards AI compute instead of Bitcoin mining, but they've also sold about 28% of their Bitcoin treasury, according to BitcoinTreasuries.net. And of course, who can forget Nakamoto? They dumped a big chunk of their Bitcoin holdings at a 40% loss, at least according to a report by 21 Shares, at the end of June. So the point is that previous cycles have tended to ink their bottom only after a big capitulation event, and this may very well be what we're seeing. So in that perspective, these announcements are actually potentially really, really good news, especially if Bitcoin survives where it's at without dropping much lower. That would be really cool. Last week, we mentioned that one of the turning signs that indicated maybe a bottom was forming was that the Bitcoin ETFs were seeing positive inflows again after several weeks of huge outflows. Well, that trend continued this week, with Farside investors reporting that as of today, an additional $438.8 million has flowed back into the Bitcoin ETFs this week alone. As of showtime, the Bitcoin ETFs cumulatively hold 1,272,000 Bitcoin, which works out to more than 6% of the total supply of 21 million that will ever exist. Plebs, it's even more than Satoshi Nakamoto is estimated to hold, with Satoshi's holdings supposedly around 1.1 million Bitcoin. So that's a big chunk of Bitcoin, more than Satoshi, more than Michael Saylor. 6% of the network supply, the total ever supply of 21 million, is pretty significant, and that trend apparently is continuing to re-accelerate. So again, I would never recommend anybody purchase an ETF. You do you. This is not financial advice. I understand why some people do. Obviously, you can't. It's really difficult anyway to hold Bitcoin in your retirement plan. Certain retirement plans won't allow it at all. Or if you have a 401k through work and they specify Like the last fiat mining job I had a 401k, and you couldn't even specify. You didn't even have a menu of investments to choose from. You had like two choices. Did you want to be aggressive? Did you want to be moderately aggressive, or did you want to be safe, which was kind of like just bonds or whatever? And that was your only choice. So if you are in a 401k and you're not allowed to hold Bitcoin, the money's being paid for by your employee anyway, or matched. Okay, if you can invest in ETFs, I get it, I understand. But the point being that does, in theory, increase the demand for Bitcoin as long as these ETFs are actually holding the Bitcoin that they're holding. But most of them don't do proofs for reserves, so we just have to take them at their word. We were told, we were led to believe that FTX, for example, had billions of dollars of the Bitcoin that they did not have. But once again, I digress. Positive sign as far as Bitcoin adoption is concerned, and as far as maybe this bear market finally bottoming out, that normies and ETF buyers are pumping money back into the ETFs again. Getting back to Bitcoin corporate treasuries for just a minute, this marks the third week in a row that Michael Saylor's strategy has not purchased Bitcoin, focusing instead on accumulating cash to support their dividend yield products, those paper Bitcoin products I spoke about just a minute ago, instead of stacking Bitcoin. It appears they haven't sold any Bitcoin either, so that is good. But Michael Saylor tweeted on Monday, strategy has increased its USD reserves by 225 million. As of 7/19/2026, we hodl 843,775 Bitcoin in our Bitcoin reserve and 3.2 billion in our USD reserve. So Saylor continuing to focus on shoring up his dividend, his yield offerings instead of increasing his Bitcoin strategy. Bummer that he has to do that during a bear market, but when he could be stacking Bitcoin on the cheap. But it is what it is. Despite the fact that so many are saying that this feels like the worst bear market in Bitcoin's history, I do want to take a minute to remind you that that is not the case, and that's not even close. I've said in the past that these cycles don't get any easier. Your third, fourth cycle in doesn't necessarily get any easier than your first cycle in, because your holdings get bigger, or even if you don't hold any more Bitcoin, the fiat value of that goes up. And so it feels harder. Let's say you've got on paper $10 million of the Bitcoin, and then it drops to less than $5 million of Bitcoin. I mean, that really hurts, as opposed to, when Bitcoin was $1,000 and you watched your holdings go from 1,000 to 500, even though the percentages were the same. But while it has felt particularly brutal, especially because most people we just mentioned didn't feel that the bull run lived up to, the expectations that so many of us had. But so far, this cycle, our low so far has only been around $58,000, which is a decline of more than 54% from the $126,000 all-time high last fall. But putting it into perspective, last cycle, Bitcoin pulled back from its all-time high of $69,000 to, in the $15,000 range, which was a drop of more than 77%. So way worse than the 54% pullback we've seen so far. The cycle before that, Bitcoin dropped from its high of around near $20,000 to as low as $3,000, which was a drop of more than 84%. And of course, the cycle before that dropped by 87%. So currently, with the price of Bitcoin down less than 50% now from the all-time high, if the bottom is in or close, that would be a pretty impressive improvement over previous cycles. So that's actually a big plus when it comes to Bitcoin price stability. Nick, who is at Nick BTC Bull on Twitter, he posted about this on Thursday, posting, higher lows each cycle are the most important metric in Bitcoin. 2014, $200. 2018, $3,200. 2022, $15,500. 2026, 57,000 parentheses so far. Definitely do not ever want to make a lower low. So not quite saying the same exact thing where I was saying that we're not seeing as big of a sell-off in percentage-wise. He's looking at the fiat dollar values of those amounts, but similar metric nonetheless, and similarly bullish. In the meantime, Imagine going back and meeting your November 2018 self. And your 2018 self drones on and on. It just won't shut up about how they just can't take another month or two of $3,000 Bitcoin. The most boring bull run ever, the most horrible bear market of all times. At $3,000 of Bitcoin, woe is me. What will we ever do? Well, you'd smack yourself upside the head and say, fool, stack as hard as you can. And thank God for this opportunity as long as it lasts. Because obviously it didn't last. Bitcoin is like time. That's its biggest thing. It just marches on. Tick-tock, next block. Like the universe itself. Bitcoin doesn't care what we're panicking or celebrating. Bitcoin just mints another block every 10 minutes or so, and every 210,000 blocks, we have another halving until eventually the miner reward is reduced to where there is no miner reward other than fees, and all 21 million Bitcoin have been issued and in circulation. And, it might seem like I spoke about in the very beginning of the show, where it doesn't seem like it's been 5 years. I've been doing this podcast. Sometimes I have my ups and my downs in this podcast, and I lament about, how long I've been doing it or whatever, but it doesn't feel like 5 years. That 5 years just goes screaming by. I said it's a lot like having kids. If you have children, you have a baby and you're changing diapers and waking up all the time during the middle of the night to make sure they're fed or, they're comfortable, if they're crying, and it just seems like your life is frozen and this is never going to end. And then you blink and then they're off to college. And in a lot of ways, Bitcoin is like that as well. It doesn't feel like I've been a Bitcoiner as long as I have, and it doesn't feel like I've been doing this podcast as long as I have. And it doesn't feel like we should be less than 2 years away from the next halving. While the flip side is, with the staying up all night with the baby changing the diapers, feels like we're in the middle of this bear market that never going to end. But we're going to blink and the next halving will have occurred and the next bull run will have occurred. And we'll be looking back at how freaking retarded we were for whining about $60,000 Bitcoin. Whatever the new all-time high is, however far in the future you're listening to this podcast. If you're listening to an old podcast, for example, hello, future me, hello, future you. If you're listening after the next halving or after the 2032 halving, and we're sitting at 1 million or whatever it is per Bitcoin, and you're listening to it, you're laughing because people were complaining about how tough it was having to slog through $60,000 Bitcoin. But getting back to why we are Bitcoiners, we all know that things are not particularly rosy out there. I mean, even the normies can feel it. They might not understand what money is, etc. They might not know why it feels like, they're in the rat race and it's a slog. But, as Bitcoiners, we know that it's largely because the money is broken, whether you're talking about, how far your dollar goes or whether you're talking about other crises that are going on in the world. The saying is Bitcoin fixes this. The current global reserve currency, it's an endlessly depreciating farce. I mean, it's lost more than 98% of its value since it was created. And of course, Bitcoin, with its absolute scarcity of 21 million, is the exact opposite. I mean, it's completely the solution to all of the problems that come with having to trade hours of your life for paper money that one guy can print out of thin air, and it doesn't cost him anything to do so. But along those lines, we are still, I believe, very early on in Bitcoin's adoption. I mean, the proof of the pudding is that, it isn't not only the reserve currency. You can't go to Publix or Safeway or Aldi or whatever and spend Bitcoin without using some sort of service that converts it into dollars for you. Most of us are familiar with the phrase gradually then suddenly, whether it's from Parker Lewis's essay or whether it's the original quote, which you may have read in Ernest Hemingway's 1926 novel, The Sun Also Rises, where his character Mike Campbell uses it to explain his financial ruin, that it happened two ways, first gradually, then suddenly. But the same thing has been historically true of fiat-based currencies. I mean, our current US dollar Ponzi scheme isn't the first time that this chicanery has been tried. Historically, there have been many fiat currencies, and they've only lasted an average age of about 30 to 35 years. Some previous examples of the fiat currencies would have been the French assignat, which lasted for 7 years, hyperinflated and collapsed. The German Papiermark, which lasted 9 years before they had hyperinflation. The Hungarian pango, which lasted 19 years, but then suffered the worst hyperinflation in history. Yes, even worse than Venezuela and Zimbabwe. And of course, the Zimbabwean dollar, which actually lasted 29 years before it was destroyed by hyperinflation. So putting that into perspective, it's been a relatively long 52 years now that the US dollar has been officially a fiat currency since the gold standard officially ended in 1971. I guess it's more than 52 years. I'm dating myself here. It's more like 54 years. Nobody has a crystal ball. I often say that about many things, but history does show us how we should expect fiat to end, and it will end. And of course, we know that Bitcoin is the lifeboat. Christine Lagarde, the president of the European Central Bank, said that Bitcoin was an escape hatch, and she nailed that on the head, but she didn't mean it as a good thing. She meant it as a bad thing. Like, people are going to be able to escape us and buy Bitcoin and be able to save their money instead of having to suffer through our euro printing. But again, we don't know when the bear market will end, and we don't know when fiat will collapse. Nobody has a crystal ball, but we do know that both of those things will happen. We don't know when, but when it does come, as the saying goes, it will come suddenly, and for the most part, unexpectedly. Even though we expect it to happen, if we woke up tomorrow and the dollar was worthless, a lot of us that have been stacking Bitcoin, maybe we haven't been stacking as hard as we thought. We didn't think the dollar was going to end tomorrow, and we're going to be in a world of hurt. And that's unfortunate, because it's going to hurt a lot of people, because not everybody's on a Bitcoin standard yet. And hopefully the bear market lasting a few more months, a few more years, however, it won't last a few more years. We're only 2 years from the halving. Traditionally, what happens is the bear market bottoms out about a year after the all-time high, and then kind of grinds its way slowly through. A lot of people were calling it the crab market, or the bear crab market, or the bull crab market. I'm sorry, bull crab market, because it felt sideways, but it was going up gradually. And then we get towards the halving, and usually sometime, but this time it was before the halving, but normally after the halving. But in general, around the halving, Bitcoin retakes its previous all-time high, plus or minus a few months. And then a year after the all-time high, 18 months after the all-time high, we're really in that bull market, and that's when we set the new high. And then, of course, it all begins again. But the point being, in the meantime, since we don't have a crystal ball, all we can do is stack as hard as we can and as fast as we can, because eventually nobody's going to be willing to trade you Bitcoin for that increasingly worthless slip of paper that the Fed prints. So in the meantime, as the fiat world continues to fall further and further behind, there are examples of it everywhere. On Sunday, Lawrence Lepard, who's my personal favorite gold bug because he's also a Bitcoin maxi, kind of a weird combination, but he is. He tweeted about the economy, retweeting a post from Amy Nixon where Lawrence Lepard said, "K-shaped economy in one chart." And Amy Nixon had posted a chart saying that personal bankruptcy filings in the U.S. are up 47% since 2022, with a chart showing a rapid increase in personal bankruptcies, with 549,577 personal bankruptcies in 2025, according to LendingTree, which cites the source U.S. courts. On Saturday, Yahoo Finance ran a headline that paints this gloom and doom picture, with foreclosures hit the highest level since 2019. Bargain hunters take notice. And another headline from the same time, pending home sales dip in June. U.S. sales dropped 0.3% from a year earlier and 5.4% from May. So in fiat land and normie land, things are slowing down. Inflation is biting in. People are going bankrupt. Remember, people were financing their Chipotle burritos through Klarna. People are hurting out there. Here on the Bitcoin Bulletin Podcast, well, we've been in the lifeboat and building our share of the solution for the last 5 years now. Each week, we've been stacking sats in our weekly DCA segment. Well, what is DCA, you might ask? DCA, of course, is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. So, for example, 5 years ago now, we set our equal portion at just $20 US, and we chose weekly for our regular interval. Like so many things, these are both you do you things, but I chose $20 a week because I wanted to show you that it's not too late to get off zero. Obviously, we've shown that over and over again. But I also wanted to show that it's not too late for you, even if you're of very modest means. Even if all you can afford is just $20 a week to put away for your future, that over time, it will make a difference. And I think we have proven that. Of course, I chose weekly because that is a really common interval for people to make their investments, even before Bitcoin came along. If you are contributing at work to that 401k, or even if you're not, or whatever you're investing in, you usually do your investments when you get paid. And if you get paid once a week, it makes sense that weekly would be your DCA interval, whether it's Bitcoin or whatever you're investing in. Of course, it also works out really, really nicely for a weekly podcast. But again, those are both you do you things. If $20 is nothing to you, then the stack of Bitcoin that you accumulate at $20 a week won't be as meaningful to you as if you were investing a larger sum. But for plenty of people around the world who may or may not be listening to this podcast yet, $20 a week is a significant chunk of money to put away for their future compared to what they're earning. So today will mark our 261st DCA Wednesday. In just 3 days, it will technically be the 5th birthday, the 5th anniversary of the very first Bitcoin Bulletin podcast. We debuted this podcast on Sunday, July 28th, 2021, and we didn't do our first DCA Wednesday until 3 days later on Wednesday, July 28th, 2021. But next Wednesday will be July 29th, meaning that will be the beginning of our 6th year. So that means that today's purchase will complete 5 years of dollar cost averaging. This will put the cap on 5 years of DCAing into Bitcoin. I mean, I know you might be looking at the math and saying, hey, there's 52 weeks in a year, or how is this 261 Wednesdays? Well, every Wednesday or every 4 years, we have that leap year, et cetera. So the way it works out, we have had the privilege of having 61 Wednesdays come and go now. And every Wednesday, we've stacked $20 worth of Bitcoin, which means we've already stacked 260 times and converted 5,200 US dollars into a stack of 12,067,670 Satoshis. There are 100 million sats in every Bitcoin, so that means we have 0.120676670 Bitcoin. But that stack, even though we've invested $5,200 to get there, at current prices, which are 50% below the all-time high, are still worth $7,962.24. So even with Bitcoin at its low or hopefully near the bottom of this bear market, we're still above water. And a lot of people out there saying how many people that have been in just this cycle are under. Maybe that's because they FOMO'd in at the top, and by ignoring the price and just stacking $20 a week or whatever you're stacking. If you're stacking $100 a week, you're still going to be above water. You're still going to have the same average cost basis we do. You're just going to have a lot more Bitcoin worth obviously a lot more. And that is the beauty of dollar cost averaging. Even though we only stacked a humble $20 a week, I mean, it certainly added up fast. If you were listening to this podcast wondering how you're going to come up with your $20 to purchase Bitcoin this week, and you've been doing it alongside us for 5 years, you probably feel pretty good having $7,962 of the value put away for your future. Of course, because we were ignoring price and just plugging away once a week, we do have that really enviable average cost basis. The average purchase price, of course, we bought at the highs. We bought in between the double highs of the 2021 bull run, and we bought all the way up to that cycle's all-time high of around 69,000. Then we bought all the way down through that bear market and that Bitcoin winter, and then we bought all the way up to the last all-time high of 126,000. And now we bought all the way back down, of course. But our average purchase price is just $43,090.34. Not too shabby. So while I've been talking, we already had our DCA purchase go off, and that is because I automated our DCA with Strike. Strike is not a sponsor of this podcast. The reason I chose Strike is we had been using Cash App, who also was not a sponsor, but Cash App raised their fees, and so I decided to give Strike a try. And Strike also at the time would let you automate your DCA. If you set up an automatic weekly purchase, you could do so with 0 fees. Cash App will let you do that now too, but they didn't at the time. So we switched over to Strike, and it's been enjoyable ever since. Again, this is a you do you thing. We have no sponsors of the Bitcoin Bulletin Podcast. I'm just telling you what we have done. Use, though, an exchange, a company that's reputable, not something you've never heard of, but most importantly, after you make that purchase, get it off of the exchange, because even if you are using, let's say you were using FTX at this point in time during the last cycle, and FTX was about ready to collapse or had just collapsed, well, if you bought your Bitcoin and transferred it to your hardware wallet, it didn't matter that FTX is gone. They didn't take your Bitcoin with them. So not your keys, not your coins is the saying. Make sure that when you have a reasonable amount of Bitcoin on the exchange, you don't want to just put $20 necessarily Bitcoin in the hardware wallet, because it might, increase the amount of fees it costs you to move those Bitcoin later, because you have so many different UTXOs you combine at $20 a time. But the point being, if you have enough money on an exchange that it would really make a difference, or really make you upset if you lost it, get it off the exchange and into your own self-custody. Strike has already made that purchase for us. It triggered when Bitcoin was a little more expensive than it was when I started going over the statistics. About $100 more. We paid $66,126.63 was the price for a Bitcoin when we made our purchase. That means our $20 bought another 30,245 Satoshis, and it brings our total now up to 12,097,915 sats, currently worth $7,999.94. Not too shabby, considering we've invested now just $5,220 into Bitcoin, and we're near the cycle low. Imagine how that's going to look when we're back at all-time high territory. Because we purchased for more than $43,000, that does affect our average purchase price. So our average cost basis has gone up by about $57. Our average cost basis is now $43,147.93. That's still pretty good, considering Bitcoin's ringing in right around $66,000. So not too shabby at all. Of course, as I alluded to, when Bitcoin retakes its all-time high, our fiat value of that stack is going to be even higher. For example, just when Bitcoin crosses the $100,000 mark again, something it may or may not do before the next halving. If history repeats, we'll probably break 100,000 before the next halving. And when that happens, our humble stack, without adding one more Satoshi, would have a US dollar value of $12,097.91. Keeping in mind, again, we've put just $5,220 into Bitcoin now. Standard Chartered predicted that by the end of 2026, that Bitcoin would close at $200,000. I have a hard time seeing how we get there before the next halving, but eventually Bitcoin will be worth more than $200,000. And when it does, our humble stack will be worth $24,195.83. And of course, that big moon target for a lot of people, that $1 million threshold, when Bitcoin hits that mark, whether it's next cycle or whether it's after the 2032 halving or whenever, our humble stack will be worth more than $120,000 US dollars, $120,979.15. And keep in mind, next Wednesday, we're going to buy $20 more worth of Bitcoin, and we're going to keep plugging away. So the longer it takes to hit 1 million, the more sats we're going to have when we get there. Of course, OG cypherpunk Adam Back made the grand prediction that by the year 2032, after the 2032 halving anyway, one Bitcoin will be worth more than $10 million. That might seem pie in the sky, but when Bitcoin's at 100,000, it only has to 10x to hit a million. And when Bitcoin does hit a million, it only has to 10x to hit 100 million. And we've seen Bitcoin more than 10x from its current price many, many times during its history. So not out of the question. I firmly believe it will eventually. Bitcoin has to hit $10 million. The law of supply and demand says that well before we're talking about hyper-Bitcoinization, we should cross that mark. And when it does, our humble stack will be worth more than $1 million US dollars, $1,209,791.50. But on that path to hyper-Bitcoinization, on that path to everything divided by 21 million, Fidelity Investments Director of Global Macro, Jurian Timmer, remember back in 2022, Fidelity said that by 2038, one Bitcoin would be worth $1 billion. Billion with a B. that is really hard to envision. But plebs, I've been here since before 20,000 was hard to envision, and 20,000 happened, and people said Bitcoin will never hit 100,000. Well, we've done that. So, those Bitcoin changes you, and it changes a lot of things. And one of the things it changes is what a big number is, right? $1,000 was a big deal. And then $20,000 was a big deal. And $69,000 people thought was a really big deal. Maybe not as big as 58K, but a big deal nonetheless. And then 126,000, well, that's just disappointing now, right? I mean, imagine thinking $126,000 would be a disappointing number back in 2016 or 2017. So the point being, our perspectives shift, our perspectives change, and it might be hard to see how $1 billion a coin could happen, but it's easily on the glide path if Bitcoin becomes the world reserve currency. And when it does, our humble stack will be worth a staggering $120,979,150. All of that for scraping up just $20 a week, totaling now $5,220. All right, that's it for this episode of the Bitcoin Bulletin Podcast, and that's it for 5 years. Next week, we will begin our 6th year of stacking Bitcoin together, and I think that's pretty cool, and hopefully you do too. And before I go, though, I want to ask you to do me a solid, to do me a favor, and that is to make sure you're feeding that algorithm monster. You can do so by making sure that you're following this podcast on each and every podcast app you're listening to. That you have your automatic downloads enabled, not only so you don't miss the podcast, but so, we get cred in the algorithm. Make sure you're following the podcast on X, where we are at BTC Bulletin Pod, the letters BTC Bulletin Pod, as in short for podcast. But even more important than that, by following us on Twitter, you can reach out and say hi. You can let me know what you think about the podcast, because my DMs are open, and I do reply to each and every DM from our listeners. Along those lines, you can also send me a good old-fashioned email. The email for this podcast is bitcoinbulletin@protonmail.com. That's bitcoinbulletin@protonmail.com. I do read and reply to every email I get from listeners as well. Of course, you can always send a good old-fashioned shout-out through a boost, and that means we'll read it on the next episode, starting our 6th year, after the 5th anniversary, beginning the 6th year of the Bitcoin Bulletin Podcast. But most of all, I just like to hear from you. You don't need to send a boost, send a DM, send an email. Let me know what you think about the podcast, what you've enjoyed about the last 5 years, what you look forward to in the next 5 years. Either way, though, don't forget to join us next Wednesday as we start year 6 of the Bitcoin Bulletin Podcast, as we continue to grow that stack. We continue to stack Satoshis as long as anyone is silly enough to sell us Satoshis for paper dollars. But until that time, keep on stacking those sats, you sexy sat stackers.